Good day. This is ACT 113, Elements of Banking. I will be taking you through study section 5, Element of Banking. When you have studied this section, you should be able to explain the concept of capital market. You should be able to discuss the financial forces reshaping money and capital market. The financial instruments or securities traded in the market include equities or ordinary shares, industrial loans, preference shares, federal government development stocks, state government bonds, company bonds, and debentures and mortgages. Securities traded and in the capital market mature as from 3 years and above. The development of the capital market stems from the realization that household, corporate, and institutional savings can be mobilized and channeled for investment purposes, thereby reducing the clamor for foreign sources of funds, which oftentimes have political and economic strings attached thereon. The possibility of mobilizing funds domestically through the capital market induces expansion and growth by the firms through forward and backward integration, which are made possible cheaply. The capital market provides funds for such development. The growth rate of capital market depicts the growth in investment and the productive sector of the economy at large. So we can define capital market as a financial market for the buying and selling of long-term debt or equity-backed securities. This market channels with the wealth of savers to those who can put it so long-term productive use, such as companies or government making long-term investment. What are the major participants in the Nigeria capital market? The major participants are the Securities and Exchange Commission, the Nigerian Stock of Exchange (NSE), market operators, investors, insurance companies, pension funds, unit trusts, institutional investment, and individuals. Central Bank of Nigeria. The Federal Ministry of Finance in Nigeria is required to ensure 20% of premium collected with the National Insurance Commission. So these are the major participants in Nigerian capital market, NCM. And I want you to know that the SEC, which is the Security and Exchange Commission, the SEC is responsible for the overall regulation of the entire market, while the NSE, which is the Nigeria Stock of Exchange, is a self-regulatory organization in Nigeria capital market that supervises the operations of the former quoted market. So market consists of issuing houses, merchant banks, stockbroking firms, stockbrokers, trustees, registrars, and so on and so forth. What about the major participants in the Nigerian market? We have the finance companies, Bureau de Exchange, and the exchange control regulations. The finance companies are institutions that specialize in short-term non-banking financial intermediation, while bureaus de change in order to broaden the foreign exchange, the market, and improve access to foreign exchange, especially for small users. Bureaus de change have been authorized since 1989 in this regard. The third one, which is exchange control regulations. Unconditional repatriation of capital, profit, and dividend is allowed, while technical fees and royalties on imported technical service and technology are payable. Let's talk about how to access the Nigerian capital market. This is very, very important. These specialists provide the company and government with financial advisory services. It is their duty to study the company's performance over the years in order to determine its financial needs. Necessary approval from SEC and other bodies are obtained. If financial options involves listing on the stock exchange, the brokers to the issuers It ensures that all necessary approval with the exchange are also obtained, since only stockbrokers can introduce issues to the exchange. On the completion of the offer, the proceeds of issue are handed over to the company for executing the proposed business program on long-term investment, and the securities it's been listed on the daily official list of the exchange. For individuals wishing to invest in the central market in form of buying shares, what they need to do is to consult stockbroking firm and register with the broking firm. In continuation, let's talk about development financial institutions, DFIs. It's a specialized banks or development finance institution, and they were established to contribute to the development of specific sectors of the economy. We also have insurance companies and primary mortgage institutions, PMIs. In order to enhance their operations and make their effort felt in the economy, most of the former DFIs in the country have been merged and restructured. The DFIs from the merger and reconstructing are the Bank of Industry (BOI) and the Nigerian Agricultural Cooperative and Rural Development Bank (NACRDB). The two banks provide soft loans to industrialists and those engaged in agro-allied ventures. These existing DFIs are Federal Mortgage Bank, the Urban Development Banks (UDB), the Education Bank (AB) to cater for the sectors reflected in their names. The Nigerian insurance industry has grown tremendously over the years. The funds were sourced mainly through reduction in outgoing and other assets, which together account for 80.8% of total funds. In reaction to distress in the sector, the Federal Mortgage Bank of Nigeria tightened its surveillance of the institution by issuing claim bill of health to 116 mortgage institutions. Let's talk about modern capital markets and electronic trading system. Modern capital markets are almost invariably hosted on computer-based electronic trading system. And in primary markets, new stock or bonds issues are sold into investors, often via a mechanism known as underwriting. And also, the main entities seeking to raise long-term funds on the primary market are governments, which may be federal, state, or local government, and business enterprises companies. Government tends to issue only bonds, whereas companies often issue either equity or bonds. Most can be accessed only by entities within financial sectors or the treasury department of government and corporations, but some can be accessed, talking about modern capital market and electronic trading system now. Most of them can be accessed only by entities within the financial sector of the treasury department of government and corporations, but some can be accessed directly by the public. Entities hosting the systems include stock exchanges, investment banks, and government departments. Physically, the systems are hosted all over the world, though they tend to be concentrated in financial centers like London, like like New York, like Hong Kong, Lagos, and Abuja. Capital markets are defined as markets in which money is provided for periods longer than a year. Key division within capital markets. Periods provided for periods longer than a year. Key division within the capital market is between the primary market and secondary market. The money markets are used for the raising of short-term finance, sometimes for loans that are expected to be paid back as early as overnight, and on the whole, not later than 1 year. On the other hand, the capital market are used for the raising of long-term finances, usually as purchase of shares, or for loans that are not expected to be paid back for at least a year. As we talk about difference between regular bank lending and capital market. The regular bank lending is not securitized. Securitized. It doesn't take the form of resellable security like a share or bond that can be traded on the market. Lending from banks and similar institutions are more heavily regulated than capital market lending, and banks are more accessible for small, medium, and companies. And lastly, banks have the ability to create money as they lend. What about financial forces reshaping the money and the capital market? You see, one of the most important changes currently sweeping through the financial system is financial innovations, that is, the development of new financial services and instruments. Every year, new financial service and instruments expand rapidly in variety and volume. The effect of deregulation, broadening of the financial market. Now, let's explain more about all this under financial forces reshaping the money and the market and the capital market. Home equity, credit lines, international mutual funds, currency and interest rate swaps, and loan securitization, and many other financial services and instruments emerge as in the capital market, they emerge in the market. Moreover, rapidly growing service innovation has brought with its service creation as each financial institution expands the menu of services it is willing to offer customers. One of the causes of the ongoing rushes to innovate and develop new services and technique is the rise of intense competition among financial service providers. The rapid rise of intense competitive rivalry has been fueled in part by deregulation. Governments around the world in Africa and that is the United States of America, Europe, Japan are freeing financial sectors from many government rules. As government regulations are lightened and eliminated entirely, the private market becomes more and more important in shaping how financial service providers compete and service providers compete and perform in order to serve the general public. Financial services competition is increasingly taking the place of government rules in the hope that the public will benefit in terms of more convenient services at lower cost. The expanding competitive struggling in the deregulated financial marketplace has given rise not only to new services and new financial instruments, but also to new types of financial institutions, large multi-products, multi-market, technological sophisticated, sales-oriented organizations that are designed to weather the risk and inherent in today's volatile financial marketplace. Financial markets have traditionally been local in character and are expanding to become regional, national, and even international scope. This market broadening reflects recent advances in communications technology. Such breakthroughs offer the prospect of reducing service delivery costs, improving employee productivity, bringing new financial services online more rapidly, and expanding the effective marketing area for both old and new services. Today, many commercial and consumer loans are traded in national and international markets, providing new sources of liquidity for financial institutions, making these loans and improving the availability of credit to the public. As new financial services make market develop, business and government will have less reason to borrow from traditional financial intermediaries and more reason to sell debt and equity security directly to investors in the open market. So I hope that with this you've been able to understand to some extent the financial forces reshaping the money and capital. Okay, thanks for listening.